When the S&P 500 launched in 1957, industrials made up 85% of its weighting. Factories, steel mills, and oil rigs defined the American economy, and the index reflected that. Fast forward to today, and the picture looks completely different. Software, cloud computing, artificial intelligence now dominate the index's weighting. Has that shift fundamentally changed how major equity benchmarks relate to one another? The S&P 500 is a market cap weighted index. That means a handful of giant firms can drive its entire movement, and that's exactly what's happened. Fueled by the Magnificent Seven, the information technology sector's weight has surged from under 7% in 1990 to nearly 40% today. That level of concentration has a consequence. The S&P 500 is increasingly behaving like the NASDAQ 100. Since 1995, the 6-month and 12-month rolling correlations of their returns climbed from roughly 0.6 to 0.96, and it kept going. By March 2026, the 12-month rolling correlation hit a new all-time high of 0.98. These two benchmarks are now moving almost in perfect lockstep. Meanwhile, the S&P 500's relationship with its equal-weighted counterpart is heading in the opposite direction. Before 2020, the 6-month and 12-month rolling correlations of daily returns frequently sat above 0.95. Since then, it's drifted lower, often hovering around 0.8 with wide, volatile swings. The gap between the lightest and heaviest sector weights has never been greater, and it's pulling these two versions of the same index further apart. History puts this into context. The energy sector peaked near 28% in 1980 after the oil shock, then faded. Tech hit 33% during the dot-com bubble at the turn of the millennium, then reverted. Financials topped out around 22% before the 2008 crisis, then pulled back. Each of these events was a peak and a reversion. Today's IT weighting of roughly 39% is different. It's unprecedented in both its scale and its staying power. So what's really driving this? Some argue it's concentrated momentum, a feedback loop of rising prices creating more weight, creating more buying. Others see it as something more structural, a genuine shift in how the economy creates value, driven by technology that touches every industry. Or perhaps it's both. A new industry quietly develops for years beneath the surface and then hits a tipping point where the entire world notices at once. Either way, the benchmarks are telling us something. The question is whether we're watching a new era take hold or a cycle approaching its turn.